I think there's a lot of risk and uncertainty, and there is a chance that oil prices go way higher. And most investors and most institutional investors and allocators are way underexposed to that risk. If you went from $75 a barrel or so, we're at right now, WTI, to 90, there's not really a lot of evidence that you're going to have a big demand shock to the downside. And so, that could be an argument for prices actually to rise even more.
Oil has seen a volatile year. What's next for energy and the energy markets? We're talking about this with Josh Young. He is the CIO and founder of Bison Interests. We'll talk about what his fund is doing as well. And what he sees happening for not just oil, but oil stocks. Welcome back to the show, Josh. Good to see you.
Thank you. Thanks for having me back.
Bit of a decline today, 1%, 1.5% down on the WTI on Wednesday, August 14th, after the CPI numbers came out. I'm reading it's because of geopolitical tensions dying down potentially, but we'll talk about that. First, let's talk about your broader outlook. So I think you said to media, CNBC, and on my show as well, early in the year that you still see $100 of oil by, I guess, the end of this year or next year. Is that still your view today with oil? WTI is at $77 right now?
Yeah, I mean, if you just look at the normal volatility for oil, I don't think it's that much of a stretch. We got close to $100 a barrel in October of last year, and I think we're actually set up for sort of a similar trajectory in terms of global oil inventory declines as well as escalating geopolitical tensions. And, there's a lot of discussion of geopolitics, but the reality is that there is a real risk today of global oil supplies being disrupted, and there isn't that same risk of the same magnitude of global oil demand being disrupted over that same time frame. So there's room for there to be a real mismatch, both from fundamentals, where you're just seeing global oil inventories decline, again, not in the narrative, not sort of what you normally hear, not what they're saying on TV for the most part. And actually, it was funny since you mentioned that CNBC interview. So I was interviewed, and I think there were 5 other people that talked about oil around that time in January. It was a sort of seasonal low for oil. And everyone else was bearish, including a couple of analysts that have sort of been painted as sort of perma bulls. And oil, I think, was in the low 60s, mid 60s, something like that at the time, and it proceeded to rise by about $20 a barrel. So I'm not a good market timer, but I do notice when everyone else is bearish, and I think we're sort of in a time frame where we're experiencing something similar to that right now.
What's the bigger picture for why oil has fallen from its highs of $120 2 years ago down to where it is now, and it's been trading pretty much rainbound for 2 years, a year and a half?
Yeah, I'd say the 3 biggest surprises in the oil market versus the consensus view at that sort of $120 a barrel price level. One is that Russian oil supplies did not come off materially as they were expected. I thought that the sanctions that were in place would cut, let's say, 1 million barrels a day off Russian oil supplies in the short term, and then another 1 million barrels a day over time. They've cut 1 million, but not 2. And then the consensus was 2, and then maybe eventually 4, and they certainly haven't sort of cut off those supplies. So that's the first aspect that's been wrong, where I was wrong and the consensus was wrong. I was trying to be conservative on it and ended up right on the short term, but then you haven't really seen much of a fall off in Russian supplies beyond that. The second is that the U.S. appears to have significantly relaxed the enforcement of sanctions on Iran around that time a couple of years ago. And so you've seen Iranian oil exports up close to 2 million barrels a day over the last 2.5 years or so. And so I think that's extra supplies that's come onto the market that no one really expected. And, it's sort of shocking given what Iran's been funding and their involvement in some of this sort of geopolitical mess and maybe even organizing or orchestrating this attack on a U.S. ally. So that's been sort of a second surprise. And the third is China's demand has been disappointing. So I think the consensus would have been that China would be consuming about 1 million barrels a day more oil today than they are if you rewound a couple of years ago versus right now.
So I have a few questions on geopolitical risk premiums being potentially factored in or not. So this is an article from CNBC published earlier today on the 14th of August. Oil prices fall after Biden says Iran could refrain from attacking Israel if ceasefire reached. Now, as we know, Iran has not yet retaliated against Israel for the killing of their Hamas chief. However, it's speculated that they would soon. Oil futures fell Wednesday with U.S. crude closing below $77 a barrel after President Joe Biden said Iran may refrain from attacking Israel. Biden told reporters Tuesday afternoon his expectation is Iran would not strike Israel if a deal is clinched to stop the fighting in Gaza. Though he said efforts to broker a ceasefire are getting hard, Iran has promised to retaliate. So I don't know to what extent the U.S. is going to be successful in brokering a ceasefire. Anyway, what's your take on the situation and ultimately what this would do to oil?
So the joke on the buy side and also on the sell side to some extent is if you fail as an oil fund manager, as an oil market analyst, you can go write headlines for oil news. So I just don't think. I think there's a normal amount of volatility in the oil market and you just see it. And so, if oil prices move up and down by about 25% in each direction any given year, you have to have a headline to explain those movements. And so you just see it's sort of like market news where it's sort of nonsensical. The shorter the term, the harder it is. And frankly, some of my friends who are reporters say something similar where it's like, hey, what am I supposed to say? And then, I sort of know this isn't real, but it's okay. So anyway, I don't think that's the right way to measure geopolitical risk in terms of the very sort of short-term movements, especially in a move that's like a one standard deviation move. It's just sort of a normal market move any given day in the oil market.
I see. So it may or may not have anything to do with what Biden said. But generally speaking, though, the tensions in the Middle East, are you factoring that in at all?
Yeah. So I've had the view that ever since the October 7th attack on Israel, where a bunch of civilians were killed, that this would lead eventually to either direct disruptions in oil supplies, which it already has to some extent with some of the tankers and other ships being attacked off of Yemen by the Houthis, which are backed by Iran and supplied by Iran, and maybe also funded. It's sort of complicated where their money comes from. But I thought there would be sort of even more disruption than we've seen there. And sort of in spurts, you've sort of seen these moments of sort of increased tensions. You saw actually a direct, almost unprecedented attack on Israel by Iran, and then a retaliation by Israel on Iran on Iranian soil, which was something you hadn't seen in a very long time. And then you saw a subsequent attack by Israel on Iranian soil. So these things are sort of unfortunately step changing up towards sort of more direct conflict or war. And one other thing to notice that I think increases the odds of an oil supply disruption is that so far in the conflict up until recently, there hadn't been any attacks on oil infrastructure or oil development equipment or infrastructure. And so you saw in a recent attack, Israel, in response to attack by the Houthis directly on, I can't remember exactly where the drone or rocket landed, but there were some people that were killed, I believe, in Israel by a Houthi rocket. In response to that, Israel destroyed an oil export terminal in Yemen that was believed to have been helping fund the Houthis. And then shortly after that, Hezbollah sent a either rocket or drone. Again, the reporting on some of this stuff is sort of complicated, so that's the uncertainty. But they attacked a Israeli drill ship that was drilling for gas in the Mediterranean, and that drone or rocket was shot down. But both of those are sort of big steps up towards attacking larger scale energy export infrastructure and production infrastructure, because up until that point, these things hadn't happened, and these are, I think, in the last couple of months. So I think the odds are higher of the oil supply disruption.
The scare here is that if Iran does escalate, or if either side escalates, the Iranians could close down or shut down the Strait of Hormuz. Let's assume this happens. I'm not saying it will. How impactful would this be for global oil supply?
So I'm not sure if Iran would actually shut down the Strait of Hormuz, or if Israel would bomb Karg Island or something like that, some of Iran's oil export infrastructure, or if some other tankers, Israel just sanctioned some tankers that have been servicing Iran. Maybe they go sink one of those or seize one on the open seas or sort of off the coast of Israel. Anything along those lines could be enough to disrupt oil supplies. And I think the impact to oil price would depend on the scale. So if it's seizing a single tanker or a couple of tankers, maybe that would be good for a $5 or $10 move up in oil prices. And it's unclear how sticky that would be. It would depend on if Israel continued to do that. If it's bombing, let's say, Kharg Island or something like that, you could see a couple million barrels a day of oil exports go offline for a period of time. That could be good for, let's say, 20 to maybe $40 a barrel, sort of similar to the, Russia's invasion of Ukraine and people thinking you'd have a couple million barrels a day of Russian oil come offline, which we saw briefly. And I think it was April of 2022, you saw about 2 or so million barrels a day of Russian oil come off the world market. And then if Iran did shut or partially shut or even threaten the Strait of Hormuz, that would be potentially, I think there's something like 20 million barrels a day that goes through that. Saudis have oil pipelines that can divert oil partially away from that. So maybe it would be 15 million barrels a day or something. And then presumably Iran would not threaten their own exports. So maybe it'd be closer to 10. Anyway, that would be sort of $50 plus price impact, potentially a lot more, and a lot more similar to the two disruptions you saw in the 1970s, where you saw oil prices triple or so over the course of those escalations. And so, I think those are real risks. And I don't know, I think like the 20 million barrel a day sort of call would be extraordinarily unlikely. It would just not, there's a lot of reasons why that wouldn't happen. But a smaller impact, I think, is a lot more likely. And frankly, just I think in the news today, there was news that Israel hacked the Iranian central bank. And so, and I think they might have even publicly admitted it, which is sort of weird and noteworthy. And so, as you see them go after the Iranian sort of economic infrastructure, bombing oil export facilities, they're very explosive. And Israel has shown the ability to sort of get ordnance into even more secured sites than that. So it's possible, and I don't know how to evaluate the probability, but I think it's worth at least thinking about because of the underexposure people have to oil and oil and gas stocks, as well as just I don't think there's a dollar priced into the price of oil today for any of that risk.
The issue of logistics and supply chain disruptions affecting oil, to what extent would it push the price upward? Now, keep in mind during COVID, during the pandemic, the oil price actually went negative at one point because of global demand disruptions, or supply chain disruptions, rather. How was that different from what could play out today?
Well, COVID really was more of an issue of governments forcing people to stay at home and sort of forcing the cessation of economic and recreational activity, which really cut into oil demand. It is actually amazing if you look at it that oil demand only fell by about 30 million barrels a day during that time, despite you could look on roads, they were almost empty and global economies almost screeched to a halt. And you still were using close to 70 million barrels a day of oil. So it was still, it's sort of amazing if you look at that, how little oil demand was affected, relatively speaking. Yeah, price went negative very briefly and for sort of one futures contract and for, one day. But price was very significantly disrupted, but that was a demand shock to the downside. This would be a supply shock, not a demand shock. And then the other aspect of this that's relevant is what's the elasticity of demand? So the price elasticity. So how much does price increasing destroy demand? So how much does the oil market balance itself? And the evidence is that anywhere close to current oil prices, there's very limited oil demand elasticity to price. So if you went from $75 a barrel or so, where we're at right now, WTI, to 90, there's not really a lot of evidence that you're going to have a big demand shock to the downside. And so, that could be an argument for prices actually to rise even more, even if there's a relatively small supply shock. And then the one other historical thing to look at would be in 2022, where there were refinery constraints that sent the refining margin up to $50 or $60 a barrel, which essentially added another $3 or so per gallon to the price that people were paying for gasoline at the pump. So that did hurt demand, but that was because you had $120 oil plus, let's say, another $50 effective from this refinery constraint. And right now, refinery margins are closer to $20 a barrel. So there's a lot of room to even get back to the price that you were at net to consumers at the pump a couple of years ago. So there's a lot of room for price to move up before you'd have a real demand impact.
I like to address the latest IEA report that came out yesterday, I believe. Now, they revised down their outlook for oil demand from 970,000 barrels per day to 950,000 in 2025 on the backdrop of weaker macroeconomic conditions, including a slowdown in China. The report says weak growth in China following the post-COVID surge of 2023 now significantly drags on global gains. This is on the supply demand side. What's your reaction to this report? Do you think that's been factored into prices?
So the IEA has a sort of it's almost like a field of dreams sort of approach towards modeling the oil market, where they hope and sort of advocate against oil. They want oil prices to be low, and they want oil demand to go away to hit sort of their own. They set net zero sort of climate targets and various other shifts to electric vehicles and reduction in global oil demand as sort of a institutional mission. So their modeling always sort of seems to solve back towards that rather than try to be calibrated in reality. So this year, maybe their oil demand estimate will be more accurate than, let's say, OPEC's, which OPEC also reduced their oil demand estimate. But OPEC reduced it from, I think it was like 2.2 or 2.4 million barrels a day of growth year over year to 2 million barrels a day. So OPEC's still way higher estimate-wise. The IEA is at the way low end of that range. And the right number is probably somewhere in the 1.4 to 1.6 million barrel a day demand growth year over year. And a lot of that is from air travel, which you can just observe is way higher, as well as from various chemicals and sort of other uses, even with sort of relatively weak diesel demand with a weak global economy and weak sort of transportation demand, as well as lower than expected gasoline demand in the US and other Western countries.
Well, let's talk about policy changes. I like to show you first. We'll talk about both potential Harris win as well as a potential Trump win. This is what Trump said to Elon Musk during the Twitter space earlier this week. Take a listen here.
Someday you might be able to, but I do hear we have anywhere from 100 to 500 years left. Much of it hasn't even been found yet.
Yeah.
But there are tremendous, like Anwar. I got Anwar in Alaska approved. Ronald Reagan couldn't do it. Nobody could do it. Everybody tried. Nobody could do it. I got it approved. The first thing that Biden did was unimprove it to get rid of it. He ended it. His secretary went in and she ended it. And what a disgrace. That's Anwar. That's bigger, or they think it could be bigger than Saudi Arabia in Alaska. Could be bigger than Saudi Arabia. But they went in and they terminated it. And I'll get it going very quickly, because not only is it big for Alaska, I mean, you talk about economic development, that for the United States, I mean, that is, they say bigger than Saudi Arabia or the same size, and pure, really good stuff. And, they end it. So I think we have, perhaps hundreds of years left. Nobody really knows. But
hundreds of years left of reserves in the U.S., Alaskan reserves potentially bigger than Saudi Arabia. Can you address this?
Yeah, I mean, look, politicians lie, and so it sounds good. I think the part that he said that's true is no one knows how much oil is really there, both in Anwar as well as sort of, across the U.S. There's a lot of exploration that hasn't been done in the last decade or so. I think you and I, but before we started this interview, we were chatting about sort of my longer term view on oil and why I've been sort of persistently bullish over time. And so one of the things that's kept me the most bullish is just tracking global exploration activity and then global delineation activity. And so much money that's been spent on oil has been spent on sort of short cycle shale projects and other things like that, where you get your initial rate and you're down 70% in the first year and another 50 or 40% in the second year. And so there's really not enough exploration that's being done. And so we really don't know how much oil there is, but those aren't reserves. That's sort of contingent resource or potential resource. In terms of reserves, that Alaskan oil reserve, and that's protected due to wildlife migrations and stuff. I mean, that's good for maybe a couple million barrels a day, at least as far as I've seen, and in terms of the companies that have sort of approvals to go ahead and develop. I think like Conoco has a project there that they were going to go ahead with, and they were stopped by the Biden administration. I think we have dozens of years left of oil reserves at the current trajectory, and I think it is a mistake to be inhibiting development that's relatively environmentally friendly. I mean, I think people forget, they think about this, they think, oh, it's beautiful. I mean, the reality is I've been up to Alaska, not to Anwar, but near there. And I mean, it's pretty desolate. But the reality is, if you just go on the other side of the Arctic, you can see, I mean, they won't let you visit it, but it's there. There's drilling by Russia, and actually in Norway. I mean, they sort of pretend like they're very concerned about the environment, but they drill these wells in the far northern reaches and places where if there's a spill, it can be catastrophic environmentally. And so if you look at how Americans develop these things, we have all the different rules and regulations, as well as just reasonable corporate responsibility. I think it would be a reasonable place to go develop. And I think it's sort of a real miss. So I think Trump is right about that, but very wrong in terms of the order of magnitude, at least for that particular field.
Generally speaking, though, can we make the assumption that a Trump presidency would mean more incentivizing of oil drilling in the U.S.?
Yeah, I think so as I've thought about it from the policies that have been shared, as well as looking what happened under Trump's administration versus what's happened under Biden's administration, I think it's important to differentiate what's happening in the world versus what the policies have been and what those policies and regulations have done incrementally. So I think Trump would incrementally be bearish for gas because I think you would see an increase in drilling activity. I think he would probably be bullish for the valuations for oil producers because I think people would feel more comfortable, they'd be able to do their business and not be hampered by extra taxes or regulations or restrictions that would hurt their business. And I think actually he'd be sort of roughly oil price neutral because even if there's more drilling activity and there's more production, I think you could also see more economic activity and less of a push towards electrification of vehicles and sort of movement towards net zero economy. And so pulling back on some of those regulations and incentives, I think could actually see a significant increase in oil demand, both in the US as well as worldwide.
Well, if you just take a look here, so what about Harris? That's my next question. If you just take a look at the U.S. field production of crude oil, this is according to the EIA website, it doesn't look like U.S. production of oil has fallen during Biden's presidency, even though they have been more vocal in prioritizing climate change and sustainability and green agendas. But I don't know if one can make the argument that the Democrats would not allow oil to continue being produced at the same pace. What do you think?
So again, I think it's important to differentiate between what's happening in the world and what's happening in terms of the incremental impact of policy. So this chart is great for this point. So under Trump's administration, and again, there's lots of complexities. Some of this had to do with discovering new fields, improvements in technology, and so on. But you can see during Trump's presidency, there was a surge in oil production to all-time high levels. And there was growth. Basically, you were at all-time high oil production levels, both of crude oil, and then I don't think this includes natural gas liquids. Those were even more. These were basically at all-time highs the whole time, growing beyond that. What you've seen during the Biden-Harris administration has been sort of a recovery of production that was curtailed during COVID, as well as curtailed production and drilling activity in the immediate post-COVID era. And so really, we might be at all-time high production, we might be sort of close to all-time high production, but we're not sort of hitting new highs all the time. And I think a big factor in that is the low valuations of oil producers because of, I think, risk of regulatory and tax and sort of other policy. There's risk and uncertainty around that, which suppresses valuation and suppresses capital spending. But there's also a reality, which is there's less exploration, there's fewer new fields. And when you have these sort of new shale fields, you have the potential to grow production, in some cases, 1 million barrels a day a year from some of these fields, like the Delaware Basin in West Texas and Southeast New Mexico, like the Midland Basin. And again, these weren't sort of new fields, but the shale plays in them were new, and those were ramped aggressively, primarily during the Trump administration. Again, neither is perfect, and it's really hard to distill. It's very hard to have sort of a fair conversation about this. And that's where, with my background in economics, I just point to the incremental impact of policy rather than the absolute sort of numbers. But it does happen in this case you can look at the all-time high versus not all-time high. It's way easier to recover production than it is to grow it to new all-time highs repeatedly.
I'm going to bring up this Reuters article. Harris's energy policy is strategically ambiguous, her aides say. Okay, the 25 days since Vice President Kamala Harris entered the race for the White House, she has kept her energy policy or energy executives guessing. Is she the climate and anti-pollution warrior who is Attorney General of California, or the pragmatic number 2 in the Democratic Biden administration that oversaw record U.S. oil production exports? We don't know yet, Josh. Based on your discussions with energy executives, what do you think?
Yeah, I mean, I think like this sort of an analytical approach is disingenuous.
Okay.
I think that if you try to disconnect a vice president from the administration they've served under's policies, I just don't think that's a reasonable analytical approach. I think you are sort of, who you associate with, but also, I mean, she's the vice president of the United States. She's spoken a number of times about energy policies. I think it's a very weird thing to look for ambiguity or differences in the very short amount of time that she's been a presidential candidate. And then she hasn't actually said anything. It's just been sort of rumors floated that her policies have changed. I don't know why anyone would believe this other than sort of, I think it helps advance her agenda that she would be different somehow, because Biden, their administration has had a lot of challenges in terms of economic and energy and other policy. So I just don't think it makes sense to distance it, other than her coming out and committing. And even if she did commit to different policies, politicians lie all the time. I think you just ignore what they say and focus on what they do. And in her case, there's almost 4 years of energy policy to track with her in the number 2 role of leadership of this administration. So I think just that whole analytical approach I think it's unfortunately intentionally disingenuous, but I just don't think it's a reasonable way to think about what might happen. I think actual behavior is way more relevant when considering what politicians might do.
So at this point, would you have any guess as to which administration may be more bullish for energy prices and ultimately energy stocks?
So I think that Trump will be better for energy equity valuations and ultimately better for sort of just absolute levels of energy stock prices, because I think there would be less risk around regulations and taxes and less sort of burden on the companies that are producing. So even if you had a slightly lower oil price, which again, my sort of base case is a relatively neutral oil price, him not being bullish or bearish, because you have incremental supply, but also incremental demand through incremental economic activity and reduced sort of impetus for electric vehicles and so on. I think you'd have better valuations for these businesses under Trump and worse valuations with maybe higher prices and almost definitely higher natural gas and NGL prices under a Harris administration versus a Trump administration. But again, I think you do better probably in a variety of sectors, but particularly in energy with Trump over Harris. This isn't an endorsement or anything like that. Frankly, I thought both of their policies weren't amazing. So I guess I'm sort of a political misanthrope, but just thinking about it from a price perspective and a share price movement perspective, that's how I see it.
Finally, let's talk about valuations. So you brought up valuations of energy stocks several times. Do you have any comments as to whether or not you prefer small caps versus large caps from a valuations perspective?
Yeah. So the starting point is there's this great chart Devon Energy put in their recent presentation. I don't own the stock. I'm not recommending it or anything like that. They show 4% of the S&P 500 is energy stocks, and those companies represent about 10% of the earnings for the S&P 500. And so I think that's worth thinking about. That ratio has varied by a little, but historically, energy stocks were as high at one point as 30% of the overall index. And then when you look at you look at fund ownership of energy stocks, it actually looks like it tilts under the index weight. So the index is actually the S&P 500 actually is over tilted towards ownership of energy versus what a lot of public equity fund managers are exposed to. I think partly because energy has underperformed the last couple of years and has underperformed over the last, let's say, decade or so. So I think generally energy stocks are cheap and underowned. But then when we look at the specifics of the valuation, so we went through and looked at consensus estimates and what a number of different investment banks thought across many companies. I think we gathered over 100 companies to do this study. And we saw that The on 2024 numbers, so not forward looking, it sort of gets messy because gas prices are expected to rise, natural gas and oil prices are expected to fall based on the forward curve shape and so on. But we saw that large cap oil and gas producers were trading close to 6 times EBITDA, which is sort of, I think, a reasonable metric. It sort of cleans up a lot of the capital intensity and other complications. That's why I use EBITDA and not earnings for especially upstream oil and gas producers. So 6 times, and in some cases 7 times or higher EBITDA on the large cap side. You saw about 4 times or so EBITDA on sort of the mid caps, and in the small caps, you're at sort of 2 to 3 times EV to EBITDA. And there were a number of cases of companies that are trading below 2 times EV to EBITDA on the small cap side. And the reason that's relevant, like we talked about, is I think people are underexposed. I think there's a lot of endowments, a lot of institutional investors that are underexposed, partly because they have some of their exposure through the index, where it's 4%, where it should be 10% on earnings. But then they're also underexposed because they'll use some active managers that are value managers or growth, whatever, to substitute for index exposure. And those managers, it looks like for the most part, are actually underexposed, not overexposed to energy. So you have these endowments, pensions, whatever, that might actually only have 3% or 2% exposure to energy stocks versus the S&P at 4% and earnings for those companies at 10%. But then when you go down to the small caps, you can basically get 3 times the earnings exposure through buying a small cap with $1 than a large cap. So there's this huge miss where if you're an endowment, you could basically put 1% more of your money into small cap oil and gas stocks and get essentially 3% or so earnings exposure or EBITDA exposure. And I don't know if that math is sort of easy to carry over, but because they're at about a third of the valuation, you get about 3 times that EBITDA number by buying, you only have to buy a third as much in order to get that same exposure. So you have this opportunity to get a lot of exposure with relatively little capital. And that matters because what happens if the Strait of Hormuz is blown up, or what happens if the U.S. Shale producers disappoint, or if Trump wins and gasoline demand in the U.S. rises 500,000 barrels a day in a year, or China restarts and starts growing again, or various other factors. And again, there's a lot of complexity in the oil market. I don't think that anyone really knows what's going to happen to the price of oil in the next few months, but I think there's a lot of risk and uncertainty, and there is a chance that oil prices go way higher. And most investors and most institutional investors and allocators are way underexposed to that risk. And so I think it makes sense for them to have more exposure here, especially given all the risks and uncertainties, and to get that exposure in a very capital efficient way by also buying sort of these value small cap oil and gas stocks.
Okay. Excellent. Thank you very much, Josh. I appreciate your time. Where can we learn more about you and from Bison Interests?
Yeah, just at bisoninterests.com. I think it's sort of the best place to find us. You can sign up for roughly a monthly newsletter, and happy to be in touch with anyone.
Excellent. Thank you very much, Josh. Appreciate it. Thank you.
Thank you.
Thank you for watching. Don't forget to like and subscribe.